Good day, fellow investors. We continue with our summary of the margin of safety, and don't get fooled by the boring title of the 1980s junk bonds. This is the core chapter of understanding how Wall Street works and how to avoid it, and these are the takeaways. The first takeaway is how Wall Street creates something out of nothing to get fees, and how that crashes inevitably later. We have had junk bonds, other bonds, housing market, specs now, etc., etc. They do it by creating new measures of valuation, EBITDA, which explains the bubble and bust cycle, core thing to know when it comes to investing. Klarman also explains why EBITDA is bad for investors, and then also how collateralized anything looks good at first, but it usually spells doom on Wall Street. Plus, there is an extra bonus in this chapter, and there is a tip how to get rich on Wall Street fast. You might enjoy that if you are such a person. So please smash that like button to support the channel if you enjoy these summaries. Value investing is a bad topic. My last video was the least watched, so please smash that like button to keep, let's say, pushing value investing and this book as a core thing for the investing community. We have done already chapter 1, 2, and 3. We are now at 4, and then next week we'll continue with the value investment philosophy, how that works. But let's now start with the junk bonds and everything example that's used just as an example. We'll use others to explain what Wall Street is and how it works and how don't fall into Wall Street traps. The fact is that it's always greed and ignorance that leads into the short-term focus and mindset of Wall Street. That's the incentive of Wall Street that we already discussed in the previous chapters. And in this example, Klarman discusses how Wall Street creates a $200 billion market out of nothing, and 200 billion that was in the 1980s, now 200 billion is nothing, but that's what Wall Street does, creating something out of nothing to get the fees. Let's discuss the history and examples. It all started in the 1980s with Michael Milken. He's now a philanthropist and chair of the Milken Institute, rich as hell. He was the junk bond king in the 80s. He also did securities fraud, spent 2 years in prison, but he's now banned from the industry. But who cares? He made his money, he's rich, all well in the Wall Street industry. And the idea was that a well-diversified low-grade bond portfolio could earn a greater rate of return than a high-quality bond portfolio. Of course, the greed for that yield. And here is the start of every bubble. Everything he did is correct in the beginning. Nobody wanted bonds at the start of the 1980s, so those were cheap, those were really value investments with high yield. The economy was doing great, and then the bubble started. When people understood that every company can issue junk bonds, they would get more money than they needed so that they can refinance and get more money, and that's how they started taking advantage of the greed of investors for higher yields. And you can also read the book Investing in Junk Bonds that explains that from Altman and Namaher. Going forward, this is the core explanation of how it works. It creates new measures of valuations by discarding old measures of valuation and creating new ones, and by mastering the art of optimistically projecting and compounding results further and further into the future. Wall Street was able to generate demand to match and at times even exceed the burgeoning supply of junk bonds. It was junk bonds in the 1980s. Keep this in mind, optimistically projecting and compounding results further and further into the future. Let me give you a current example. If we just go to ARK, expected value for Tesla, they have a beautiful Monte Carlo model that they don't even know how to use, but that's irrelevant for them. They make it optimistically. Further, they project that in 2026, 54, 58, 66% of Tesla's revenue will be made by things that don't even exist now on the income statement. So projecting something that will happen in the future, and that is able to generate demand over the long term and sell ARK funds and everything. At least that was the case until things were going good. The new measures of valuations now is growth. Back then, it was also something else, junk bonds, high yields, EBITDA. And then there was also, okay, we help the industry, new technology. Then it was small businesses getting new products on the market. Now it is new technology businesses changing the world by doing this or that. But at the core of everything, Wall Street issues those bonds, Wall Street works on those takeovers. Wall Street makes money if you make a spec, go public with it and everything. They get their fee and they don't care about that. As long as the bubble is going, they make a lot of money.
You don't get smarter because you're running something called a hedge fund or something called private equity or something, called anything, an LBO fund. But what you do gain periodically is the ability to merchandise those things. I mean, there are fads in Wall Street, and Wall Street will sell what it can sell. Just remember that.
Then a great example here, this is from the housing crisis in the 2000s, and everything is perfectly explained by Klarman also in the book written in 1990, because CDOs, then rating agencies get paid a lot of money to rate those CDOs positively, of course. Then it creates a bubble because, look, you can make a lot of money, you can trick the system, everybody happy, from the rating agency, from investors. The bubble starts going and everybody makes money, but then at some point the supply is much bigger than the demand, and then we see the real fundamentals, and then you have the crash and the CDOs fell apart, everybody lost money. You can read more about that in the article by Tomlinson and Evans, Toxic Debt. You can just search that. But that is how Wall Street works. Now we are issuing not junk bonds, okay, of course, a little bit, but the mania was specs. Well, we all know the results there. And the mania was so big that even Shaq thought it was a slam dunk. It became a free throw for him, and everybody else also got in on the bandwagon just to make as much money, and Wall Street was happy to help them get into those because it was a big fee, a big way to make money. Even Donaldinho made a spec, and the number of specs boomed when the Fed printed money, free money, zero interest rates, and then crashed when the situation changed. That's usually how the bubble works. It starts with the greed, because maybe here, yes, it was interesting to start one, there were opportunities, but then when the money and when the self-reinforcement cycle starts there, then everybody goes on the bandwagon, and when everybody's doing, it's usually the place to avoid. And that's correct. Early successes of Milken and everyone of the first SPAC investors, early successes, the Teslas, lead to unrealistic expectations, the Nikolas, etc., etc., etc. And that's the self-reinforcing cycle, and that cycle works perfectly when rates are down, the economy is up, all is well, until a certain point. Because when the self-reinforcing cycle is, everybody wants to make more money, and then this happens in a bubble, relaxation of investment standards, because individuals like the high yield, saving and loans, say, okay, we have to do it to invest. Insurance want higher yields, mutual funds get on the bandwagon. And so you have a bigger and bigger bubble on those relaxation of investment standards, and that is helped by easy money. We have seen that over the last 10 years. That keeps defaults low when things are good. Let me check back in a year, how will currently speculative grade bond defaults be? The projections are a little bit higher here, but that's also very detrimental for the market. And then the key is that Wall Street always wants to push, to sell, to make everything look good. And they do it by using then and still now EBITDA, which clearly doesn't differentiate between a good and bad business. Let me show you. So in the past, we have had earnings, then cash flows from private owners, but that was not enough because you can't really be excited about it. And then Wall Street created EBITDA, departed from historical norms, and then they said EBITDA is the one that we have to focus on, the best representation of value of a company, because EBITDA is earnings before interest, like that doesn't matter, before taxes, who cares about taxes, before depreciation and amortization, that EBITDA thinks it's not a cost because it doesn't matter, and then EBITDA may have been, this is wrongly written by Klarman, EBITDA is used as a valuation tool still 30 years later because no other valuation method could justify the high takeover prices prevalent at the time. Wall Street, investment bank, merger and acquisition, the bank gets the fees, so they are always incentivized for companies to take over, to synergy, to this, to that. And 90%, according to the Harvard Business Review, 19% of those mergers are actually detrimental to shareholders. That's insane, but EBITDA is still used everywhere with companies because it makes you look so much better. It obscures the difference between a good and a bad business. Just look at this example. Service company X, no depreciation because it's a service company, doesn't have assets. Manufacturing has assets, you need to replace those machines, thus there is a cost to that and you need to invest every year. The difference is EBIT 20 for a good business, 0 for the bad business. But if you use EBITDA, nobody cares because these two businesses look all right. And actually, this company looks much better with EBITDA at 20 than other. Thus, Wall Street wants to push EBITDA, is still used, taught in business schools and everywhere, but Charlie Munger calls it bullshit earnings.
How anybody can turn that into something they use as a metric that talks about earnings is beyond me. Charlie?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
And it's up to you whether you want to believe the investment bank, the business school that you paid 200 grand for, or Charlie Munger that's a multi-billionaire and tells you the truth, or Seth Klarman. It's up to you. Then just a quick note on collateralized junk bond obligations. And Wall Street likes to put everything together because it looks much, much better, but that's the thing that usually leads to doom on Wall Street. In the meantime, they make their fees. So CBOs are diversified investment pools of junk bonds that issue their own securities with the underlying junk bonds as collateral. Tranches and everything, and then they repackage it and sell it for their fees as the underwriters do it. Rating agencies perform studies that investment grade ratings is warranted. That's how it works. And I ask myself how smart Seth Klarman is. He wrote this in the 1990s. In the 2000s, it happened over and over again. Great book, genius book. Everything you need to know about investing is there. And that is because the greed is unlimited and will work again always and forever. The bubble cycle on Wall Street. And that's my tip if you want to get rich fast. Just go on Wall Street, identify the next cycle. Just look at the past cycles. What worked, it will again emerge. Biotech companies, rare earths, mining, whatever, because that's how you make money. And people are so greedy, they want to give you the money on those bets. You make money on the fees. Do it for a few years. Of course, they will lose at the end, but who cares? You get your fees, you invest in value investments, and that's how you get rich fast. That's perhaps the best tip that I have for getting rich fast. Just go into Wall Street, get fees on the clients, and that's it. See how that fits you. And the unfortunate end is that junk bonds, specs, and everything are transformed into the financial equivalent of roach motels. Investors could get in, but they couldn't get out. They can't go out. And that's the key of the book and investing. If you can avoid these traps, Wall Street traps, you can compound over the long term and make a lot of money. And as Klarman says, there will be new investment fads in the future. So those will expand beyond the rational limitations of the innovation. That will happen. There will be no bells with will toll to announce the excesses. A lot of people will lose money, as we are seeing now with the crypto and everything. But the best thing we can do is just avoid them, keep investing, and that's it. And this explains the essence of investing, or as Charlie Munger would say, just don't do stupid things. Next chapter we'll discuss the philosophy of value investment. We start with the practical side. We did the what to avoid, so please smash that like button, subscribe, so that you get notified likely next Friday when the new chapter comes out. Thanks for watching. I'll see you in the next video.